I'm James Turk. I'm a director of the Gold Money Foundation. I'm here with Ben Davies, co-founder of Hind Capital, a very successful bullion fund manager here in London, England. Ben, good to chat with you. I want to talk a little bit about the markets, but let's start first with the big picture. You know, there are all kinds of distortions and imbalances in the monetary system today. How do you see that? What's the cause of that?
Well, thanks for having me on the Gold Money Foundation videos. Very excited. I think that's a good place to start because, as Chris Powell said of Gas just now in the meeting that we were in, he said, you know, gold is the knowledge of the financial universe, and I think that's absolutely true. But what is gold? We all know now, and we begin to understand, us who are in this field, that gold is money. And not to belabor that point, but it is a very important point. But the system that we're working under now, what we call the Bretton Woods II regime, is actually a fiat currency system. And I think that's a very pernicious system. And what we mean by the Bretton Woods II system is a currency system where the US is centric to it, but currencies peg off it, and particularly China, the rest of Asia by dint of China. And that has created huge imbalances, structural imbalances, as you know. And for me, that unwind, or the potential unwind that we're seeing now as they try to hold it together, is what's causing a lot of the financial difficulties we have today.
So things like the sovereign wealth funds that various countries have, that's a huge imbalance. These huge pools of hot money going from currency to currency, seeking a safe haven or higher yields, that's another imbalance. Those are the types of things that you're talking about.
Yeah, it's along those lines. I mean, let's sort of go back to real basics and let's talk about vendor financing, which is about China being mercantilistic and exporting to the US and the rest of the world, and Europe in particular. But what do they do with the dollars that they receive? They've got a fixed or a semi-fixed exchange rate. And they want to maintain that because they're wanting to keep their competitive advantage by having a devalued or a undervalued currency, and that's what they have currently.
To keep their export industry moving,
absolutely,
taking advantage of that undervalued currency.
Absolutely. But what does that actually entail? You get a flow of dollars back into China, but obviously they have to deal with those dollars, so they have to sell their own currency in order to maintain the peg. Now this leads to a huge FX accumulation, which we've seen go from probably 500 billion to 3 trillion in China alone. In fact, currency reserves have gone from 500 billion to 11 trillion in a 9-year period. Now you tell me that's a sign of a stable financial system. Clearly not. You don't have that kind of level of foreign exchange reserves. So for me now, we're in a situation where the QE2, I'm running ahead of myself.
You're anticipating the future.
The QE3. But the QE1, the QE2 that we've seen has just created more FX accumulation, which they're having to deal with because it's now starting to create inflation. And they're struggling to hold that peg. They can't keep issuing currency. So we're finding a situation where inflation's rising globally. But probably rewind, but what's interesting is before, the reason why this system didn't appear to be so inflationary is because obviously China had a huge labor pool. And as we moved from an agrarian economy into an urbanized environment, and as they moved from sort of a lower income into a sort of middle class environment, what we've seen is wages demands have risen. In fact, actually, China has effectively said, look, we realize perhaps the game is up with this currency system and we need some domestic growth, and we can't completely rely on mercantile growth. That's what I think is trying to happen, but they want to let this happen over a gradual period of time, but this is where the pressures are growing.
But they're not adjusting the exchange rate in order to allow the adjustment, and as a consequence, they're going to continue to build these huge imbalances.
Well, they are, but very, very slowly.
But not fast enough, because the reserves are building rapidly.
Absolutely, and that's a function of the quantitative easing, the liquidity that we've seen in the system. It's happening at a far greater rate, which is why we're coming to a zenith point, a tipping point, if you like. So I think there's two ways of looking at the world now. Either we're going to burst this fiat bubble, this currency accumulation, and we're going to have or we're going to actually have Asian economies actually allow their currencies to appreciate, allow those structural imbalances, i.e. the current account surplus, to move towards the deficit as they go more towards domestic demand. Personally, with what we've just seen in the last couple of days, we've seen that beggar thy neighbour behaviour already beginning in the markets again. Look at Japan, look at the Swiss intervening in the market. These are all a function of the dollar distortion, and they're having to react because they've got too strong a currency now for their export market, which is the only place that they seem to be able to get growth at the moment.
It's always been my impression that the Chinese authorities have been very, very fearful of inflation, because that really has a big impact on the standards of living of people within China. They could allow the currency to revalue more rapidly to help offset the rising inflation that we're seeing in China. Is that likely to provide the incentive for the authorities to loosen this peg and start appreciating the currency much more rapidly?
Well, it's a very good point. I think they just don't actually have the growth engine internally at the moment, and also they're not an autarkic nation. They need to accumulate a lot of goods, and they obviously want to procure those easily in time, and obviously allowing the currency to rise. That probably be advantageous. But at this point, the accumulation of reserves they have because of a weaker currency actually perversely has allowed them to hoard a lot of real assets which they need for infrastructure build, which we've seen to a large extent in the last 10 years.
Yeah, but a lot of that infrastructure build has been bad investment. From what I understand, a lot of it's been wasted, built on things that have not been economically productive. We hear the stories about empty cities, waiting for some future occupants to occupy them. So is a lot of that money in accumulation of capital has been wasted?
Well, again, you bring up an interesting point. I'm definitely not schooled enough to be a Chinese expert. I've travelled there, I would consider extensively, but in order to really understand the country, and it's so vast, you have to spend, I think, many years in that country. And I don't think a few weeks here every year really counts. But I think you'll have those who say that there's been a huge misallocation of capital, that there's huge white elephants, and that actually the speed of growth of some of the infrastructure. We just saw a Chinese train, one of the bullet trains had an accident, and everyone immediately starts saying, oh, they're Chinese buildings, it's of poor quality. I always remember the analogy of my work partner who said, had a spanner that he was using his house on some DIY, and he broke it working on a radiator, and his father, who was helping him, pulled out of his bag, he pulled out this steel from a steel spanner from the trenches, would you believe, and said, this was your grandfather's, this is British steel, and this won't break. And sure enough, and that's all about utility value. They've created a lot of goods at very cheap value. To actually answer your question, I'm undecided on that, and I think that it pays a lot to give more attention to what's actually going on within their financial system. But it's so opaque. We're not really sure how much of the loans, how much of them are already starting to go wrong already. Mm-hmm. But one thing is I'm very sure of, that this infrastructure build hasn't ended, because there are 200 million plus people still needing to move into the urban environment. And that's going to need a lot of resources, and they have deficits in that regard. They need copper, they need iron ore. It's going to tail off. The rate of growth will not be the same. But those who are, I think, calling for an impending doom in China, I would probably say that they will be able to manage that deflation, if that's the right word.
Do you see China going back to some kind of a gold standard? They've been an accumulator of precious metals. They still have a relatively small amount compared to the total value of the reserves. But do you think they'll eventually impose the discipline of gold on their money creation?
I think they are making a very tacit move to do that. I do believe that from my experience with dealing with state government there in terms of the central banks. In my former life, I was a head of bond trading in London for US government bonds, and we were the #1 dealer for the PBOC and SAFE. And I was very impressed with their knowledge. They, in fact, I always remember a particular lady there had a book of Hayek on her desk. These are very intelligent, well-schooled individuals about the capitalist system. I think they fully understand that a sound monetary system predicated on a physical asset such as gold is the way forward. But I think they're doing it in a very clever way, which is they're encouraging, and it doesn't take much encouragement because they have a natural affinity, their population, but savings in that country is taking place through now deposit accounts at banks backed by gold. So I think they would be able to put their currency in such a situation to have a gold backing because the populace already owns gold, so it will already be in the hand as a medium of exchange. And just to say one last thing about that, China perhaps have more reserves in gold than we already know. I think
I'm a believer of that.
It's a command economy. It's no coincidence they came out and said, oh, actually we had a little bit more, but like the Saudis said, oh, we found a few hundred tons more.
Yeah, no, I believe they've been accumulating a lot more than they announced. But when it's politically advantageous for them, or they deem it to be politically advantageous, they announce an increase in reserves. I think this last one was the third one that they announced in this past decade of increase in the gold reserves. But I want to tie it back to how we started this conversation about the problems and deficiencies and the imbalances in Bretton Woods II, which is our current monetary system. You're basically saying the Chinese understand how the current monetary system is broken, and they're not going to rock the boat, but they're going to continue to take advantage of it as well as they can in order to raise the standards of living of the Chinese population.
Absolutely. I think that's absolutely where they're heading. They're not God. They can't move the Titanic, the boat, that quickly unless they obviously hit an iceberg. Which comes back to the non-performing loans. Is there a hidden iceberg there in China? And will it ever come to light? Because again, it's a command economy, and you can obfuscate to hell and back, and no one's ever going to know. Will that misallocation of capital that some people believe has occurred? I think that it will not. Any problems that occur in China, a slowdown, yes, they can start cutting rates. I mean, they've already raised rates, ratcheted rates, as a way of sterilizing all this FX accumulation they had of late. So I think they have a lot of powder. Unfortunately, it's the laws of diminishing returns. Every time that they have a fiscal spend or they open up the monetary spigot, actually they're not really getting much return on their capital. They were just as guilty as anyone else in the 2008 crisis of having a huge fiscal boom. Fiscal spending boom, and they didn't get much bang for their buck, but they got through.
And the bottom line is every time the Federal Reserve turns to the printing press, call it quantitative easing or printing money or whatever you want, because the dollar is the world's reserve currency of the world, some of those dollars are going to end up in China and cause inflation domestically. Yeah,
absolutely, and the rest of Asia. And let's talk about sort of moving onto sort of QE and perhaps, as we were talking before the interview, potential for QE3 in this country. There is no doubt growth is slowing dramatically. Markets are beginning to...
In the US, growth is slowing.
Yeah, globally. I mean, the periphery of Europe, even Germany now is starting to slow. That's an export market. It's the impossible trinity, isn't it? It's the economic trilemma where you can't control capital controls, you can't have your cake and eat it on monetary policy and FX controls as well. What we're seeing is everyone's trying to graze from the same bin, and obviously growth is slowing, and some people are going to get a bit more of the grazing, but not everyone's going to be able to keep their growth up. So growth is falling. The US clearly is going to come back, in my opinion, to some form of QE3. Unfortunately, I think that they will probably do something like buying long-end bonds, which actually I think it's a very inefficient way of trying to transmit money into the system. Obviously, I don't approve of it as someone who doesn't believe in dilution of your currency, but in the current system, if they want to create aggregate demand, I think what they should be doing is, I don't approve, but if I was Ben Bernanke and I was thinking about this, I would be wanting to stimulate the householders, because clearly they need to get rates down for these individuals. And how do you actually do that? Maybe you make reset on mortgages, FHA loans, etc. Maybe you make them cheaper. Maybe they're going to go and buy commercial real estate, but it'd be a qualitative easing, not a quantitative easing.
Yeah, but I mean, that's not going to solve the problem, is it really? And the other thing you're doing is you're just destroying the savings, the middle class and the capital that they've accumulated.
Yeah, so you and I are on the same boat on this, and I think this is what we should take out. This is what they would like to do, not what we would like to see happen. The reality is what's happened in Europe, take the EFSF and what's going to become the ESM, Exchange Stability Mechanism, in 2013. We've seen a huge fiscal transference. We've effectively got a fiscal supranational entity there that has taken over monetary policy, and they will be able to print unlimited amounts of money to recapitalize the banks, obviously with funny money, and they also will be able to bail out the bond markets. They will be able to buy bonds in the market. I mean, we saw today.
But as we both know, that's not really recapitalizing, because it's not coming from savings,
Absolutely.
It's coming from money printing.
And this is the problem. We have already spent our capital that's been available to us, true capital that was created through the private sector, because we've had such an over-leveraged system in order to pay for Social Security, Medicare, and other such liabilities. I think going forward, if we continue these policies, there is no doubt that we are going to get to one of what Mises, the Austrian economist, said is a crack-up boom. I am in the camp at this point that should they come back to the markets with some form of qualitative easing or quantitative easing, that we will only accelerate. And I think it can happen a lot quicker than people think. People talk about even those who are very doom and gloom on the paper currency system believe it can stretch out 5-10 years. But I think we're getting to a point where it's almost self-fulfilling. The more people discard each currency, from the euro, Swiss franc, we see them intervene today, that's going to have people thinking about the Swiss franc. Do I want to be in yen? No, they're intervening in that. Everyone's selling each currency. And every time they discard a currency and go into gold, it's an inverse function. And of course, the more you do that, the more gold goes up. And so it becomes self-fulfilling, and that's a positive feedback.
Was this part of your thinking when on King World News recently you were talking about $2,000 gold here in the not too distant future? That we're starting to get that self-fulfilling, feedback loop that as the gold price goes up and as more government intervention occurs in the currency markets, more people are going to move to gold?
Yeah, and I definitely want to state that this is not. This self-fulfilling prophecy here is, at this point, it's not a destabilizing moment for gold. It's a destabilizing moment for fiat currency. I do not believe that we've got the precursory patterns for a bubble in gold. That's not what I'm saying, and people are trying to label it as such. I think also I have a sort of trader's viewpoint on this. We were breaking out to nominal highs at a point where, other than Swiss francs and yen, which were all at very extreme levels already, where do people have to go? I think it dawned on people. In fact, I think I have friends who obsess about the validity of the credit system as it stands, who've never been interested in money, in terms of what it meant to them and a day's labour and what is the value of a pound. They just assume that they get a check and, hey, I can go and spend this. And when you have people like that who start to really worry about the financial system and actually say to you, well, what currency do you go in? And it all leads back to gold. And I think that's where we're going. From my trader's point of view, is as we break to new highs, who's wanting to sell the gold? We have not moved auction to a price high enough to find a long-term holder of gold who's said, in this environment, I'm prepared to sell out and go into something else.
Sell gold and take paper.
Or take paper, or take something that gives you a rate of return in a paper currency. Now, if I was a brave man, some people will say, good discount on Greek bonds. But I know this is only the just beginning, as you do, for the European Union, or perhaps the breakup of the European Union. And I think it could come down to that. And in fact, I maintain that will happen. At some point in our career, if we don't have a gold standard brought on by China or even the US, if they want to maintain, if they have the gold, which, as we all agree, we suspect they don't. If we don't have that standardization, at some point in the next 10 years, maybe even sooner, there will be some real assets to sell out of at much higher prices, to buy paper assets with a much higher yield or discount that gives you that comfort and safety. Maybe it's like in 1980, long bonds at 20%. Maybe we get that opportunity.
Yeah, markets eventually move to extreme where something becomes so overvalued and something else becomes so undervalued that disparity just can't exist, and the market ultimately clears it by bringing down the price of the overvalued asset and bringing up the price of the undervalued asset. And we see that in financial markets all of the time. But the point with regard to gold is that even, I'm agreeing to what you're saying, even though the price is high, the value of gold is still quite good at the moment.
That's a great point, yeah. And I keep saying that's a great point. But they're two distinct constructs. Price and value. Price is the level at which you exchange, and value is whether it's worth it. And hopefully I've articulated that correct.
And in this Bretton Woods II system, price is even harder to determine accurately, or because of the fact that currencies and central bank intervention, you have all of these huge imbalances and whatnot. It makes the value of the currency that much more suspect. It's like having a measuring stick that's constantly changing, and you are giving a carpenter a yardstick which is varying,
and extending it.
Or in the case of currency, shrinking it. In terms of loss of purchasing power.
Yeah, no, that's a great analogy. I think when you debase the numeraire to the extent that we're seeing now is how do we ascertain what true demand is? Asia clearly has a growing economy, and this is the positive side of what's happening in the world. We've got this booming demographic, but it's accelerating on an illusion of a standard of living because of all this money. And people will say, well, standard of living is so much higher. Unfortunately, we've spent our available capital and we have taken from future generations. And unfortunately, it's going to come back on us now, not my children and their grandchildren. It's going to happen in my lifetime, in your lifetime. And that demographics, though, that we're seeing that boom, how much is that real demand? How do you value that? It's very difficult. What is the value of a barrel of oil? Should it be 80? Should it be 10? If we divide by the denominator, just cut it by 10, or divide the numerator, slash it by 10, we can bring everything down, and that's effectively money, as we all know, is like any other commodity. It has a supply and demand.
We were talking before about some of the problems that we have in the financial system, and a lot of people say that the problem started with Lehman Brothers or Bear Stearns, but in fact, Northern Rock went belly up several months before Bear Stearns did. So one could reasonably argue that the financial crisis really started here in the UK back in August of 2007 when Northern Rock went on the rocks. And the question is what is the UK economy and financial position like today? Has it been improved, or is it still a problem?
Well, I'd actually say the problem started in 1971 when Nixon took us off a gold standard, and I believe it's 40 years
this month,
and I should know the exact date because I've written it enough
August
times.
15th.
August 15th, exactly. And thank you for reminding me. And I think that obviously the UK, as the centre of the banking universe, which it is to all intents and purposes, we have a banking system that's 5 times the size of our GDP. There is a too big to fail situation in the eyes of the government. They, from a liberal economist viewpoint, are making all the right noises about liquidation of the financial system by not spending as much, trying to bring down the deficit, the austerity. You can get rid of your debts through, you either grow yourself out of the problem, you have an explicit default, or you have an implicit default, which you devalue the currency.
Just to clarify, when you're talking about liberal economists, you're talking about classical liberal economists, not the way the liberal is used in America and other parts around the world.
Yes, absolutely, yeah. And I think, unfortunately, as you can see with the UK, they've actually, when you look at the numbers, really when they said they were going to cut spending, all they did was actually take the inflation rate off. So the stock is still rising. Public sector borrowing is going up exponentially, and I think there's a Tansy effect, which is the mismatch between tax earnings and what they're spending it on, and that's inflationary, so it builds up even more. And I think I explained that correctly. So nobody actually needs to own sterling. It's not a reserve currency. I think that it's being a small bastion of safety at the moment, if you can call it that. Because
perceived safety, view of what's going on in the era.
Yeah, and actually, I think very much that we're very much in the same place as possibly Greece.
Yeah.
And I actually think that it's going to come home to roost soon.
Well, actually, I was going to ask you that question. Is the UK economic situation more like Greece or more like Italy? In other words, it's a mess yet to be discovered, or it's one about ready to blow up?
I think that it's probably one about to blow up. It does never cease to amaze me how long markets can remain. I think some people say that speculators are going after Spain and Italy, and maybe that's true, but that's a reflection of the true state of their economies. And if you don't like to hold a bond because it's the wrong price, I have no problem with shorting it either. But going back to the UK, I think that you walk around the streets here and it's like everywhere in Europe, Spain. I've just come back from Barcelona and it feels like everything's fine. But that's obviously because we've spent our capital, made the place look fantastic. But in a few years' time, we're not going to have anything. There is no doubt that outside of London, we have a situation where people are really very concerned about their jobs. And I'm talking from middle-class workers down to sort of lower class, lower social income.
Yeah.
And I think it's going to come across in the next couple of years.
But even London is feeling some pain, isn't it? Because of the problems within the financial industry, the banking system in particular.
Well, volatility, despite how it might seem, has actually dropped off immensely relative to 2009-10. Banking profits have come down in their trading. So all the banks are cutting numbers.
HSBC announced 30,000 globally, I think.
Yeah, and they said it's going to
are being laid off.
Yeah, and they said it's, I think, a 700 or 1,000 in the UK. But yes, I spoke to a colleague who works at Greenwich Capital, my former place, now RBS, and said, just the pricing that's going on, it's very competitive. People aren't making money just in that sector. Obviously, with all the regulatory changes that are coming, they're downsizing. But a couple of years ago, just after the crisis, they were ratcheting back up again. So I'm not sure whether this is something that's going to continue, but certainly I think the UK, to really answer your point, is that we have such unbridled debts that no amount of austerity is going to help us when you've got growth effectively at zero. There's no income coming in, and just your fiscal burden is going to raise. So I think the Bank of England is going to keep doing their asset purchase programs or some version of it in time. Possibly leading to hyperinflation? I think that a hyperinflation is a political phenomenon, and that's and what is meant by that it's when you start monetizing your fiscal imbalance. That's what the Bank of England is doing. And that's what the Bank of England's doing. So anyone who says that can't happen, it absolutely can. And they are just like, take the US. QE2 stopped, and they did 200% of purchasing of the Treasury issuance in Q1 2011. Sorry, Q1 2011. And now that's stopped. Who's going to buy it? The private sector, possibly, but I think it will be some form of financial repression. You'll force the banks to recapitalize with sovereign debt. They can do that. That could be something that could happen. Actually, that brings up another point, which for me, the banking system and the way it's capitalized, but really predicated on sovereign debt, has been exposed as a Ponzi scheme in Europe particularly. You cannot have provision of capital based on a zero weighting of sovereign debt, because clearly there are scales of credit. And I think that's actually where politicians actually naively before, I don't think they did actually understand the mechanisms, and then they realized that the sovereign debt and the banking debt were synonymous. I'm not so sure they realize it yet. I mean, they're starting to realize it. Maybe some people still don't, because they continue to pursue these foolhardy policies where they're borrowing money to try to take some of these insolvent institutions and insolvent countries who are never going to meet those debt obligations. They're throwing good money after bad. Well, let me put a question to you. Clearly, the Eurozone and the creation of the European Union was in theory about creating harmony and stability after obviously the awful events of World War II, and really to make Germany impotent in terms of when they actually had the unification. There was you're going to come into the union. This is going to happen. This is when we'll allow you to have this unification. Do you think that today the reason why it went to the wire with this last solution being offered, that actually the French and the Germans are trying to have a political coup here where they take control of the union and they take control of the periphery assets?
Yeah, I think there already has been a political coup in the sense that one of the key rules of the EU is that the European Central Bank is not going to monetize government deficits. And despite that, despite Mr. Trichet's pledges of not buying sovereign government bonds, he's been buying sovereign government bonds. And so as a consequence, what you have happening is the political control of the euro, which is very, very different from the way the Bundesbank had been managing itself and managing the Deutschmark. So I think the euro is looking more and more like the pound, or more and more like the dollar, in the sense that it's not making, the European Central Bank is not making sound monetary decisions, they're making politically expedient ones. And I think that's one of the reasons why we see the gold price record highs, US dollar, record high, euro, record high, the British pound.
Even the Aussie dollar has just broken out again, back to the new highs.
Yeah, well, what we're seeing is the flight out of fiat currency into tangible assets, into a safe haven called gold. And I guess that's going to continue. In terms of your fund, I know you're a specialized bullion fund. Yeah. Do you focus more on bullion or more on the other related investments in the bullion side?
We always have a bedrock of our fund is 75% in allocated gold, which in our case is stored in a private bank in Zurich, the oldest private bank. We didn't want to have a paper asset, obviously, as a gold fund. We then create, that is the bedrock of our fund. It allows us to create a structure of being able to be over-allocated and under-allocated through some other financial instruments.
Yeah.
And we try and create an absolute return above the gold price, and that's how we benchmark. We do actually...
And you have achieved that.
Yeah, that's very kind of you to bring up. We have achieved 17, 18% annualized above the gold price. And we're very proud of that. And we feel that in our own way that our fund is about integrity, and we've helped a lot of people get out of paper assets and into an asset that's created a return. I know from my own personal account that my run rate's 10% a year in terms of inflation. It's rising at that amount. So I need to create a return for myself, at least at 20% in nominal terms, because I've got to take tax
just to keep up.
Just to keep going. I did ask this of someone who's going to be at the conference today. I said, obviously you're probably very excited about gold being higher, but are you an advocate of a gold standard, or are you just excited about feeling like you're better off? Because clearly at the moment there are people who've owned gold and silver, and particularly silver, at $6 and watched it up to 50. Mm-hmm. That's real wealth accumulation, but actually they are still a long way behind the inflation destruction that we've had over the last 40 years. Mm-hmm. So in the short term, although they feel fantastic, actually all you've done is sort of started to catch up to where we should have been before.
But there's another important message there. You're basically saying that gold and silver are still undervalued, as well as they've done over the past several years. If you look at it over 30, 40, 50-year period, they're still undervalued by the historic metrics.
Yeah, it actually comes back to what we were talking about earlier, wasn't it? Price and value.
Exactly.
And value, and people say, how do you measure the worth of an ounce of gold? And at this point, because the system's inverted the other way and everything's predicated off a dollar or a sterling, but actually historically it was off a weight of gold or silver. Now we look at it and say, hang on, gold only backs the US monetary base 17, 18%, maybe it's a bit higher now, but just to go back to the average over a gold standard period where banks were capitalized with gold 40, 50%, that takes us north of $4,500, $5,000 for a fair value.
Yeah. Would you care to venture how far this bull market has to run, not in terms of price, but in terms of time? Are we talking about 3 years, 5 years, 3 months, 5 months? What's your guess?
Well, one thing I'm speaking is, at the GATA tomorrow, and give a little snippet away. I talked about something called Benford's law, which is a power law, an exponential logarithmic function whereby that effectively, if you take something like a data series and it doesn't follow a uniform distribution, it actually, the lower digits, 1, 2, 3, you get a population of price or occurrence. You probably get 60% at 1, 2, and 3, and then as you move from 4 to 9, there's less population there. Well, we spend a lot of time between 1100 and 1400. I say a lot of time, it's actually only a year and a half, based on this probability assumption. Moving from 1400 to 2100, we should do in 10 months, which means that we should hit 2100 by January. I hope that anyone who didn't understand that, just go and read my speech when it's up on our website. But so for a bit of fun, I think that we're going to see a bit of an exponential move here that takes us to 2100, and I'm not going to venture any more than that. I've said on a basis of monetary valuation and the rate that we've already accumulated reserves in the world, we should be at 4,500. And one last thing I would like to offer is that there's so much leverage in the system. In some ways, I actually feel sorry for Ben Bernanke. I actually believe that in his intellectual mindset, that he understands this situation. He understands full well what gold means to the world. He understands we've got so much leverage, he's just got to let the air out of it very gently, and he's trying to do that manfully, working within a system that he understands. And I'd offer him that.
But at the end of the day, I'd rather own gold than US dollars.
Absolutely. And I think people say, or inflation or deflation. I think
it doesn't matter if you own gold.
Absolutely. I think that I'd be absolutely ecstatic if other assets were to go down in price, just being a bit mercenary about it, because I believe that my purchasing power will increase dramatically. When I sell my gold, I won't get charged taxes on it, and I'll be able to pick up some nice cheap assets.
The only thing I would say is that instead of selling gold, when this bull market is over, you're going to spend your gold. I really do believe it's going to become currency once again.
I would like
time will tell.
I would like that opportunity, and obviously Gold Money's been a fantastic advocate.
Well, thank you very much. Very kind of you to say that. Well, Ben, it's been a real pleasure. Been speaking with Ben Davies, co-founder of Hind Capital here in London, England. Thanks very much.
Yeah, great. It's been an honor. Thank you very much.